So much for joining us for today's State of Freight webinar. Apologies for the technical issues. My name is Marian Hensley. I'm the Vice President of Sonar Marketing here at FreightWaves, and happy to be here as always with our CEO and founder, Craig Fuller, and Head of Freight Market Intelligence, Zach Strickland, here to give you the updates on all that is happening in freight today, as well as an update since the last month. We will be taking time for questions from those of you in the audience after the discussion, so feel free to throw those into the Q&A box in your webinar console, and we'll get to as many of those as we have time for. And without further ado, I will go ahead and turn it over to Zach and Craig to kick us off.
So Zach, I want to apologize on behalf of the technical difficulties. Just nothing like having a power issue right before we go live. So
it's 2024, right? We shouldn't have any issues. Yeah.
Yeah, it's lots going on.
Yeah, so I mean, let's dive right into it because you just wrote an article. Mm-hmm. Normally your articles get a lot of traction and give me a lot of questions. So I want you to answer those for our audience today. So the thesis behind your article is that we've largely come through the roughest part of the market and it's now starting to move the other direction. Now, to a lot of people, that's going to sound weird. It's like things are still rough for transportation service providers.
Yep.
And they're going to say, wait a minute, what are you talking about? This is still bad, right?
Yep. Look, I don't think I'm saying that there's an instant recovery. Mm-hmm. Basically, we've talked about the fact that we've hit the bottom.
Right.
And I think one thing to keep in mind, J.B. Hunt came out with a not great earnings report.
Right.
Knight pre-warned a pretty sizable cut in terms of their forecast for the year. And their Q1 numbers and expectations. I think a lot of that is just the market is capitulating. So there's an interesting thing in financial markets and commodity markets where you almost need everyone to sort of agree that there's to sort of give in in order for a market recovery. To me, this is the moment of capitulation. And so what's really sort of profound about this is, a lot of the large carriers held out in terms of rate concessions and contract rate concessions because they didn't want to give back a lot of the gains they had during the COVID boom. These were hard-earned, if they would suggest they were hard-earned gains that they got during COVID, and they were very reluctant to sort of give those back. And if you look at the earnings conference calls that came place after earnings or listen to any of the investor presentations, as well as just the anecdotes that you would have in the market, a lot of the executives, particularly the large asset carriers, were unwilling to sort of make significant concessions in terms of rates. And I think what's happened is they've realized they need to run their trucks and they've got to keep those loaded because they're going to have to take those concessions. And so some of the stuff that we've heard anecdotally, but certainly reinforced by these two reports, I'm confident more will come, suggests that they unfortunately have had to give in to concessions that they just didn't want to sort of give into. I wrote an article a couple of years ago called Shipper's Revenge. Mm-hmm. And it was funny because Cowan today used that same headline to describe sort of the J.B. Hunt, the Knight Swift's sort of earnings updates, if you will. And it's exactly what's happened is the shippers have the advantage. And so we're seeing the larger carriers capitulate, I think try to think about, I want to gain share, I want to make sure I have it, it's going to go on for longer. But the reason that makes me more bullish is that I think we had to have that moment where those guys are willing to sort of, that whole that contract spot delta that we've talked a lot about on this program, we needed that to sort of level out to a point where it goes back to more traditional norms. And I think as we see contract rates refresh, as new rates come in, I think we'll see more of that. So I am bullish for that reason, as sort of the capitulation. I'm also, one of the interesting things on the data side is volumes actually are relatively strong. If you look at the contract load accepted volume, it's up 9% year over year, which is actually a pretty big spread.
My clicker's not working. So we'll get the CLAV pulled up here in a second, but yeah, technical.
So CLAV is up 9% year over year, and
there it is.
Here we got it here. We pull up on screen.
Yeah, I mean, and to explain what contract load accepted volumes is this is just an index of the accepted tender volumes from shipper to carrier. It has no rejected tenders in it, and it's actually a pretty good measure of absolute volume carried by some of the larger fleets.
Yep.
Is that right?
It doesn't measure a lot of the overflow freight that ends up in the spot market, just because it is strictly a one-to-one relationship in contract freight. But if you want to understand sort of the total market or the market volume in contract, this is about as reliable as an indicator. It's up 9% year over year. It is down 6% since the 2021 peak. And what that tells me is that volume is fairly robust. It's just too much capacity. One of the other things to keep in mind is that if it's up 9%, the Atlanta Fed, GDP now, has said that GDP growth year over year in Q1 was up 3%. So if you look at the fact that it's up 9%, freight volumes always exceed, there's a multiplier effect to GDP. The old rule was 1.5. So if you had a GDP growth of 2%, you would typically see freight grow at 3%. It is conceivable that you had a 3% GDP growth and you have 9% more freight, frankly, because inventories were drawn down.
Yeah.
Consumption's a little bit sort of different. So it is also conceivable that if we're down 6% from the peak, it's conceivable that if we get a 2 to 3% GDP print this year, that we could be back to sort of where we were a year ago. And I think that says that from a volume standpoint, at least contract rates are being fed, or contract freight is being fed into the market. And I would suspect that things sort of start to come up. I'm not suggesting it's a V shape, and I'm not suggesting that there's going to be a massive surge. I want to make sure that's very clear.
Right.
I am suggesting that we've hit the bottom. I actually think May of last year was the bottom.
Yep.
You sort of look at the volume data. We're trending along the bottom, but I actually think the J.B. Hunt report, the Knight report, and we'll hear a bunch of other earnings reports from the larger carriers. Those are moments of capitulation. Those are moments where the larger carriers have realized that they're going to have to do things that they did not want to do, or frankly, in a normal sort of market would have been not done at all. They've had to do it to keep their trucks and their equipment fed.
Yeah, and the one I think you're referring to specifically, Knight Swift, I think we have the article available here that you can kind of show here. Yeah. Todd Maiden wrote this article covering the Knight Swift, basically cutting earnings expectations. And I think one of the biggest takeaways for me personally is something you just talked about, how they said they're basically turning down contract freight. Now, you and I both know that contract rates are actually still elevated versus spot rates.
For sure.
So why would they say this? Why would this be a strategy?
Well, I think they're turning down some of that contract freight, frankly, because they're not wanting to give in to concessions. They don't want to make concessions that shippers are demanding. So what isn't stated in that is at what rate? Because a contract rate could be $1 a mile. It's still a quote unquote contract rate. I think what they're saying is they're being selective on what freight. And look, they have been, as the largest for-hire truckload carrier in the country, J.B. Hunt's business model is quite different,
Very different.
than Knight Swift's. But as in Knight Swift, they almost feel like they have to sort of be the disciplinary in the market, because if they're not, it's going to set the tone for everybody else, because everyone else is sort of in a slightly inferior position.
Right.
And so I think they were one of the fleets out there that was talking about that they were more willing to park a truck than they were to sort of give rate concessions. And we've heard anecdotally that they were doing that. I think what we're seeing now is a situation where they've realized I can't do that and keep my trucks running. It added 8,000 trucks with U.S. Express, and so it added a lot of additional capacity.
Right.
And U.S. Express had 40% of their trucks focused on the spot market when it sold. So it has a lot of capacity that it has to deal with, and that's caused it to perhaps make some concessions that otherwise wouldn't. But I do think that, again, this is stuff that we've all expected to happen. I think quite impressive that Knight Swift and others were able to hold out as long as they were, of not making significant pricing concessions, or contract rate concessions. But to me, this is sort of the beginning of the sort of recovery, is we need capitulation. And I think we're finally there. And this quarter will be the moment of capitulation. We will look back in 6 months and say that truly was the worst quarter for the earnings for the larger carriers that we've seen. And I think we'll move forward through the rest of the cycle. So I think fundamentally data-driven. I'm more bullish. I have reasons to be bullish. I think in terms of just looking at it from the perspective of the larger carriers, I'm more bullish. And look, they're dealing with abysmal reports. Wall Street sold off on these two reports because Wall Street was, frankly, did not, they traded off the stock 2 years ago. Like if you go back to when the freight recession articles that we wrote,
Right.
they initially sold off, but those stocks largely recovered and it continued to sort of, up and to the right.
Right.
This is, I think, a correction where Wall Street has said, wait a second, the recovery has not happened as fast as we anticipated, and they're resetting their sort of expectations.
Yeah, because we are arguably in year 3 now.
We're in the third year.
Yeah, we're starting the third
That's the other thing that is interesting. If you think about it, like everyone has a different definition of when the freight recession started.
Right.
I go back to the article we wrote about the freight recession, which would have been March 31st, 2022. We are, over 2 years. That was over 2 years ago. And so we're starting in our third year in the freight recession. If you sort of look at the COVID calendar and you sort of look, if you book in the recession as sort of Q2 or April 1st of 2000 and the freight recession of 2022, and you look at COVID as, I always call it the NBA moment. Remember when the NBA and the NHL shut down? It was March 12th of 2020 due to COVID. The president came on after that. But it was like the NBA moment when the sports league said they weren't going to play. That was, to me, the moment when COVID was real, at least in the United States. And that was March 12th. And so we spent 2 years, and really the COVID surge didn't happen until summer. Like it was really June before you started to see the recovery started in April, but you started to see a real significant bull run.
It was actually, I think we were debating this.
We were in the 3PL
April, in April or May of that year, and we were watching OTVI. If we want to pull that one up, the OTVI, the Outbound Tender Volume Index, actually had hit a floor, and I don't know that I actually have all the way back there. Man, it's crazy. We've come this far.
It's been a long time.
It's 4 years ago, over 4 years ago now, and I don't even have it available on here, but arguably,
you can get it inside of Sonar.
Yeah, you'll get it inside of Sonar, but it was the craziest thing because we were like, how low is OTVI going to go? And the chart that you're looking at,
it was like 8,600.
Yeah, it was somewhere. Yeah, it was like
I think 86. I remember it was mid-April, and I think it bottomed at like 8,600, and it didn't get worse. And I remember we all expected it. Internally, we were thinking there was bets internally that wasn't public that it may go down to the 7,000.
Yeah.
There was we're like, can it go into much lower? And actually, that was sort of the thesis that gave us sort of this view that it was going to recover much faster, frankly, because it didn't get as bad as we all expected. It didn't go too deep.
But it was a V-shaped recovery.
It was a V-shape from April, but it really wasn't until June before you saw it actually get above the levels that it was pre-COVID. And I think around that June time is when you started to see sort of we'll call the bull run, sort of that end of the quarter, sort of Q3, was when it really, really started to take off, or it was continuing to grow, and it was like, this is unstoppable at that point. And so if you think about that, the COVID cycle was at best 2 years, but probably closer to 18 months.
I do have a good chart for this. The contract rate versus rejection chart. If we can pull the contract rate versus rejection rate chart up. Yeah, there we go. So this is the last 5 years of our life. You're looking at the yellow line there, which is the tender rejection rate for dry van freight. And the period of time we're talking about, if you look at those 3 spikes.
So I can't see which is yellow and which is white.
The yellow one is going to be the one that jumps up early.
On the left?
On the left.
Okay.
And the rejection rate, of course, leads the contract rate, which is there in white. And you see how quickly, this is the sharpest spike of tender rejection rates we've ever had. And this is a 5-year chart, so it is a little bit compressed. But you're talking about...
Yeah, so that June cycle, remember when so June was the breakout, sort of got above pre-COVID into July, and it continued to surge all the way through. What's interesting about it, I've looked at this a few times, and I had forgotten about this, and I always find it pretty interesting, was it really peaked in late 2020. That was sort of the peak of it. We all think of 21 as peaking, but 21 was an incredibly robust year.
Well, spot rates peaked.
Spot
later.
Rates, they peaked later. Volume, but like in terms of sort of the tender conditions, it was really that Q4 of 2020 was the very peak of the market. 21 just happened to be such a year of like robustness. and then it's sort of all, look at the collapse. I mean, you talk about, what goes up must come down. If you remove the COVID, the entire COVID cycle, I think what you would see is the current market would not look that odd.
Right.
Like it looks closer to what we had sort of pre-COVID.
And we sort of have the inverse on a little bit shorter scale here than what we were seeing throughout 2021 there with the tender rejection index right now. If you look at that white line over the yellow line on the bottom, we're trending higher slowly. We were trending lower slowly, and then it all of a sudden fell off. Yeah. So we're sort of seeing the inverse situation. But
I think the build is actually quite healthy. I mean, it goes back to what we talked about, the reason that I think, I call it bullish, but I want to be careful because people are going to say, how can you be bullish? I'm not bullish. I have a more bullish stance than and frankly, a little bit more conviction about a faster turnaround than perhaps I did. And none of the earnings reports or forecasts have changed my opinion on that, to be clear. I think a lot of it is due to the fact that this is going to, if you look at where we started out in 2023, you got this white line. I don't know if it's on this chart over here, but you got the sort of the direction, the moving average direction. Right. It is certainly moving up in a more traditional sense.
Yeah, since last year.
The market does not act like COVID ever.
No.
Like that was an extreme part of the market.
Yeah, and we're still kind of recovering from this bubble that we built.
Well, you have a capacity bubble that you got to get rid of, and but like I said, I think the earnings reports are frankly you should take them not necessarily if you're a shareholder, but or work for those companies, should take them with a little bit of optimism in the sense that you need the larger players to sort of throw in the towel, if you will, because then the market can closer rationalize. And what will happen, I think it's interesting, the brokers gained so much market share during COVID, and they grew their businesses so substantially that they have been fighting for that volume, and we're winning a lot of that volume. So what was happening, the larger asset carriers were not willing to take rate concessions. The brokers were happy to give it to them because they could buy it on the spot market. So they were going to shippers and buying up a lot of market share. I think what we're seeing now is the larger asset carriers are now taking that back. C.H. Robinson's earnings report that we had back in for 2023,
the fourth quarter.
Their revenues in 23 were down $7 billion. And if you go look at J.B. Hunt's earnings report, there were two things that challenged them. One was intermodal, and that's just because trucking capacity is so fungible. And the second thing that really challenged J.B. Hunt was its brokerage operation. And so I think what we're going to see is a lot of the non-asset players really struggle right now because they're not going to be able to buy market share because now the larger players are playing the same rules to the degree that they weren't before. And I think shippers have always preferred assets that they can depend on versus a non-asset player, or have traditionally preferred that. And I think what we're going to see is a lot of the brokers struggle. Someone told me that Coyote's volume from sort of the sort of peak of where it was pre-COVID to where it is today is that their volumes are off by 70%, that they only move something like 3,000 loads this week per day, and suggest that they've, when they sold to UPS, it was like 10,000 loads a day, 3,000 today. It's a pretty significant fall in volume, and I think we're going to see that largely through a lot of the freight brokers are going to continue to struggle to get volume. Yeah,
I know it's going to sound like we're picking on J.B. Hunt a little bit here, but
we're not. There's a reason.
Yeah, they're the first ones that report.
Well, and it's always their business model is perhaps the most balanced business model of all of them because they have the low price freight with intermodal, and they have an incredible relationship with the railroads that enables that. Their structure, the pricing structure, helps to be first mover.
Right.
They have an incredible pricing structure for intermodal. They have the last mile delivery business. They have a really substantial brokerage operation, and they have the over-the-road truck, and they have the dedicated. And so what J.B. Hunt, I'm so glad they go very early in the cycle because it gives us
the broad experience,
and we get and you can't blame it on a single part of the it's both a low-cost provider and a high service provider, and sometimes in the same business unit, but for different purposes. And so it gives us a perspective. I think what was interesting is Knight Swift I don't know this for other than to say my guess is they watched the JB Hunt report and said, let's go all in. Let's get this bad news out of the way because we know that the whole market is going to sell off. And at least then, by the time we get to our earnings report, people won't have forgotten that we did this, or at least have priced it in.
I think that's a great point because JB Hunt obviously has an exposure. They're dedicated and intermodal are the largest components of their business. Tends to be relatively stable. I talked about it earlier today on Freightonomics too, but their brokerage experience is not unlike any other brokerage in the United States right now. They are captive by this market. And I think
everybody's captive. Yeah. At the end of the day, nobody can, gravity matters and gravity sucks you in.
Yeah.
There's nothing that anyone can do to fend off the reality of the market. Now, you can perform better and you can have exposure to certain parts of it that maybe aren't as impacted. But at the end of the day, everyone, and this is not just of the brokers and the carriers. I mean, it is also the tech vendors in this space that are selling services. And we've seen a sizable drop off in just media advertising because people are naturally pulling back on expenses. And I think that's the reality of the business is that if you're exposed to freight, then you're going to face it.
Yeah, it's a free market, so therefore it's going to do.
And it's at the end of the day, it's a commodity.
Right.
A friend of mine who works in the industry texted me late last night and was like, "Is media any better than being in freight?" I said, "Well, if it's in the freight market, not really. Like we're all sort of struggling with sort of the realities of how the market is performing or is not performing. So we're all looking forward to moving on."
Right.
But like I said, I do think that this past quarter will be the capitulation moment. And I think that's a healthy thing.
Yeah, I think too, it's a struggle. One of the things that I have trouble kind of conveying to people right now is that it's not a demand issue.
This is a hard thing for people to accept.
This is very hard because I think in the past, myself included, I've always been very tied to, well, it's got to be a demand thing that's creating this shortage of capacity.
Yeah.
It's very hard to relate to that supply side mechanism.
Because it's invisible.
Yeah.
Like demand you see, you experience it. But supply is it's not about your business, it's about everybody else's. So the total amount of capacity in the market impacts it. Whereas demand is something that you naturally see.
And let's talk about that here a little bit. You use this chart, the carrier details, net change in trucking authorities chart in your article where, I think you've said something very poignant here in the way that this is not about counting the number of trucks. This is more of a directional index.
It's a proxy, it's a signal.
Yeah.
Like at the end of the day, the actual number does not matter.
Right.
And I think this is hard for people because there's so many of these arguments that happen on social media. Like we'll put out something and people will attack the thesis because a number is different or an interpretation of that. Ultimately, all this stuff is about signals.
Right.
And this is in many ways an imprecise signal because of the way it's derived, which is taking Federal Motor Carrier Safety Administration data, cleansing it with some insurance registration information, and then coming up with a number of authorities that are out there. Well, there's a lot of things that drive authorities, but the reason I think it's important is directionally, it tells us sort of a signal on whether capacity is expanding and contracting. If you remember last time we got together, you talked about the fact that in March, we actually saw an increase in
old turtle head right there, yeah.
I think it was one of the load boards actually, it was either DAT or Truckstop, I think it was DAT, talked about that they had had seen some expansion as well in their registrations.
We had an article about it. I believe Arrive Logistics came out with a quote saying they actually saw, it was employment data.
Okay.
And they were like, a lot of people expecting a market turn. March is a natural kind of entry point where we start to see a little bit less people leave and a few more people enter because it's spring, and that tends to be the case. I don't know that that's what's happening here.
I think the grain I wouldn't pay any attention to. It was obviously a short-term blip, and it could have been the recovery in January. You also have a situation where you have carriers, drivers had sort of held on through end of the year, left the industry, and then decided to go start their own business. That takes a couple of months to get started. Could be some of that expansion going on. It also could be the spring. There's a lot of things that can drive that number. But directionally, it's red.
Yeah.
And the reason that it's important that it's red is that you've got that set at zero, that baseline set at zero. Green shows expansion, red shows contraction. we're still seeing contraction in the market. And so you think about it from the perspective of, we're off 6% we're up 9% year over year, but we're off from sort of the peak on contract CLAV.
Right.
You've got revocations still taking place and bankruptcies taking place. And I think we will see an acceleration of bankruptcies head into the spring because, throughout the spring, I should say, because I think when you see the larger carriers admit that they're having to do things that they didn't want to do with rates, they will go get share from some of those marginal carriers. That's going to put a lot of these guys at risk. And that's the whole thing is like, in some ways, Knight Swift and others have sort of kept rates, the contract rates sort of inflated and hadn't reset because they weren't sort of forcing it down. But if they're really going to go fight for market share, then I think it does sort of force the whole market to sort of play ball. And I think that's what we'll see. And I think we'll see some carriers go out of business for it.
Yeah, that's an interesting point there, because a lot of times we talk about contract rates, especially within the context of our data here, and people think about them as all being one thing, all these one set of contract rates, long-term rate agreements. There's a lot of different definitions of what a contract rate is out there.
You can have a contract rate of $1 a mile and nobody ever picks up. Maybe they pick up one load of like a couple weeks in April or something.
But the brokerage contract rate tends to be that, managed transportation, tends to be a little bit lower in general. Would you say that's accurate?
Yeah, I think so, versus the drop trailer.
Yeah. So to me, the Knight Swift signal here is listen, we're actually going to move a little bit of our capacity to this space that's a little more aggressive in terms of rate practices, because we know the market is about to turn. They're not saying that it's going to happen tomorrow.
I don't know they said the market was about to turn. Okay. I think they look, there is a whole thing when you're a public company, CFO and CEO, is in some ways when the bad news is in the market, just take all the pain you can.
Right.
Like get it all out there, because your stock is already going to be impacted. And I think in some ways, they're not going to get any credit for bullishness. Like they had a really, both of these, and I think every single one of these carriers will come out with really abysmal reports. And I expect them to be all pretty relatively negative about it, because they're not going to get a ton of value for being overly positive.
Okay.
So I think we'll see some bearishness. And I think that actually, again, I know this sounds strange, but I actually think you need that to capitulate the market.
Yeah. So do you think that this will ultimately lead to a lot of the capacity washing out? Because we've talked about this in the past.
I think it will help accelerate
that we really haven't
exits.
Seen that huge amount of capacity.
We haven't seen the wholesale bankruptcies. And anecdotal, and I've said this, it's always anecdotal, is the number of articles we do on sizable bankruptcies.
Right.
Like we saw a lot more in 2019. And the thing you have to remember is, you go back to 2019, it wasn't Q1 that we were writing bankruptcy articles. It was started in May and June and July. That's when you saw this real acceleration throughout the summer. I think we'll see a lot of that happen. And it was really end of Q4 of 19 and it really started 2020 when we started to see some of a recovery.
Sort of see that on that chart with the carrier details, where you see the very end of 2019. We didn't see that thing really turn red, and this index biases to the high side. But it wasn't until later in the year that things actually got...
You saw people turn out.
Yeah.
And I think that's what we'll see, is I think lenders are going to start, as they start having more and more trucks that they have to foreclose on, I think they will get more aggressive with it. I just think that, again, we have talked about this persistence of the spread between contract and spot that's been unusual. I don't know if you have this chart. I'd love to get it on the screen, because I think if you think about the fact that spread, this is the way I like to see it. Thanks,
All
Zach.
clean for you.
Thanks for cleaning up the chart. So the reason I love this chart is because it's a very clean way to look at the spread between contract and spot. Now, you have taken out the fuel surcharge, because that's also how I like to say it, a pure, clean chart. Obviously, sometimes there's a fuel surcharge in there. The chart itself will look identical. It just depends on where your baseline is.
Same direction, yeah.
But when you think about the fact that this shows a $1.61 spread, we got to about 50-cent spread. I believe that over the next couple of months, we're going to see compression in this chart, where contract rates are going to continue to fall. Spot rates, even if they stay flat, if contract rates are falling, that spread will come in line. And I think as that spread narrows, that's when we'll start to see a lot of the sort of capitulation in the market. Because some of these carriers, particularly the larger carriers have benefited from higher contract rates. In spite of the cycle being soft, I think they will end up this bid cycle having to give a lot of that back.
Yeah, so this chart, of course, is the spot less contract rate. So when it's in negative, that means that spot is lower than contract. And if you look at this historically, 2019, we're nowhere close. The contract rate was much closer to the spot market.
It's 50 cents to 25 cents or 35 cents is sort of the range.
Yeah.
We're at 61 cents. We still have some time. We have 11 cents from the low, but it should compress. I think as we see the new contract rates of this bid cycle go into effect.
And so the chart I had up earlier with the contract rate and the rejection rate, I think that also connects very well to this, because what that basically shows us is that as contract rates come down, if I can pull it up on the big one, here we go, rejection rates actually come up. And that makes sense to me as a person that has been in the space before. Does this make sense to you that as contract rates kind of fall, that allows, even though spot rates are largely priced below contract, it still tells me that there is, I don't know if it's a push or pull mechanism in this market, whether it's a fact that contract rates are nearing spot rates to a point where they have a little bit more optionality, therefore rejecting some loads. I don't know that that's the case.
I think what happens if you're running a carrier and you've got a really good rate from a year before, I think you're less likely to reject that. But when that rate comes in closer in line with spot, and you think about the fact that, okay, this rate was $2 a mile, now it's $1.70 or something, whatever that number is. You have more willingness to reject something that you think is below the market. And I think what's happened is a lot of carriers, reluctantly were forced to take some pretty sizable concessions on this bid cycle. And in doing so, I have agreed to take rates that they don't like.
Right.
And so they're going to be more ready to reject some of that freight when the market turns, or as it turns out, I should say.
Yeah, and I mean, it's a marginal increase in rejection rates. Obviously, it's right around 4% right now.
But this is, again, the market rationalizing.
Yeah.
It's weird to think that it's taken us, we're in the third year of rationalization. But it's weird to think it takes that long, but this was a really exaggerated cycle.
Yeah, the amount of capacity growth. I was just down in Florida talking at a conference down there. And I think one of the things that people just really don't have a concept of is how much of a bubble the COVID environment was for growth.
Yeah.
Like, especially with capacity. The amount of carriers that entered the
I don't
market.
think anyone believed it.
Yeah.
Like, even if you think back to, you wrote an article, 2 years ago maybe, or 18 months ago?
Yeah, it was about.
And you were writing about the fact that we had something like 25 or 28% more capacity.
I got a lot of
and
heat for it.
You got a ton of heat for it because people are like, that can't be true.
Yeah.
Well,
they were talking about it should be 2-3%.
We didn't add that much capacity, but if you look at all the data sets that had significant lags, and we didn't have, when you wrote that, you didn't have the benefit of all the data that we have now with the
capacity data.
And look, the government data is a pretty significant lag.
Right.
But it's true, it has come out to about that level. And I think what we're seeing now is that still has to churn out of the market. And it's weird, people will take exception to what you and I are saying about strong volumes. Something must be wrong with the data. Ask yourself this: if the GDP number is as strong as it's been, and it's not just the government's GDP data, it is the bank data, it's a lot of the global banks also do their own assessments. It is local state governments doing it. Like, you have all of these different, whether it's the Wall Street doing GDP assessments, the government doing GDP assessments, they're all showing positive growth, and you have a strong labor market. The GDP data is strong. You're not, you have a situation where GDP is strong, freight has felt soft, but it actually makes complete sense that volumes would also be strong if GDP data is strong.
Right.
Now, obviously during the COVID extremes, that all got jacked up because of the extremities and the inventory collapse that happened in 2022. So those are sort of like weird anomalies. But in the last 12 months, as inventories have rationalized, it makes sense that when you have GDP growth, you're going to have freight growth.
Yeah.
And I think, somebody had made the comment, I think it was load board data, that was put out, and somebody said that volumes were down 25%. I had somebody on Wall Street ask me this. Said, is it true that trucking volumes are down by 25%? I said, absolutely not. It's the opposite. We've seen growth. And I said, ask yourself, does it make sense that GDP would be growing and freight contracting as much in terms of volume? So what we have is this capacity overhang. It's entirely capacity driven at this point.
Yeah, and we talked about JB Hunt earlier, and I am going to go back to picking on them because they gave us some data. If you look at some of the data from JB Hunt, I'm going to pull up the intermodal. Intermodal is a good one, for instance, where we're looking at the average revenue in intermodal. Look at the revenue, 9.4% down. Look at the load volume year over year, negative 0.2%. Now, this is intermodal, it's not trucking, but the same time, it's telling me that there is a strong downward pressure on
price.
rates.
It's all price.
It's price.
Like 0.2%. Like when you look at the headline number, you're like, oh my God, JB Hunt's business, the intermodal business has collapsed. It has not. The volume is practically the same.
Yeah.
It's just that they've been forced to take pricing concessions, not any fault of their own, but due to the market.
And look, they even reduced their cost per load by 5.5%.
Yeah.
It could have been a lot worse.
You mean in terms of their costing?
Yeah, whose costs go down?
I think you make a really great point there, is that, but look at their operating income went down, their OR went up because rate does drive so much of this. I mean, yield,
no pricing
impact rate, impact yield. And so that's exactly what's going on. But I think, like I said, I think we've seen the worst of it, I believe. And this is short of a major economic downturn. Let's just keep in mind that there are a lot of things that cause significant risk in terms of a recovery. A stronger economic downturn would certainly do it if you saw all of a sudden consumer stop. But there's reasons to be bullish on the economy. PMI showed actually got into expansion territory for the first time in 18 months. That's a great thing.
And that's been trending up.
It's been trending up. Manufacturing starting to come back. The employment picture has been relatively strong. Inflation is ticking up. Like we've seen inflation tick up, which is not good for interest rate reductions. But what it does tell us is demand. You don't have the extreme inventory issues you had during the COVID cycle.
Right.
But the fact that you have some level of demand is driving some inflationary issues is not great, but it actually tells us that things aren't collapsing.
Right. And I want to pull up the IOTI real quick because I think this segues very well into our demand discussion here. Now, IOTI is the Inbound Ocean TEUs Volume Index. It's an index based on the number of bookings from shipper to or importer over the ocean for 20-foot equivalent units coming into the United States. So right before Chinese New Year, Lunar New Year there, we see a big spike, a lot of inventory coming into the country, people trying to get their goods into the country before, production shuts down across the ocean. And now we've kind of leveled off. And my question to you here, we've talked about demand being a relatively stable, strong thing, 3% in the first quarter GDP, but demand overall for freight has been very good. This looks stronger year over year. Do you think that we have found a point, because what this index really kind of tells me is that this is kind of a cadence of importing to fill those inventories up for expected.
Predominantly retail or consumer goods.
Predominantly. Do you think that we have kind of leveled out here, or do you think that we have some room to grow on the IOTI?
I think we have room to grow, and I think a lot of it has to do with the election.
Okay.
I know this is something we don't want to get too deep into.
Right.
I actually think the threat of Donald Trump winning an election is going to force retailers and importers to think differently about what do they do with the supply chain. We've seen that back, Donald Trump threatened he was going to put tariffs on trade when he was running for office, and people he will never do it.
Right.
He absolutely did it. And I think he's made statements that he's a minimum import tax of 10% tariffs. He's talked about China. I think the number I saw, the Washington Post reported 60% was the number going around. And look, he is certainly someone who has a track record of doing that. And I think it plays really well with his base.
Right.
And regardless of whether it's good economic policy or not, it plays really well with his base. And look, China, there's very few people that are China apologists right now in the world. The Biden administration has not reversed any of Donald Trump's tariffs. He's kept them in place. Well, they're both protectionist.
Yep.
And so I think you have an argument that before Donald Trump, before the election, because of the Donald Trump threat, whether it's real or perceived, will force the hand of some importers. Because I think what's going to happen is if Donald Trump does win the election, I think he's going to move relatively quickly to start putting these tariffs in place because it's something that he's felt like he wants to send a really strong message. And he's already gone through the process of doing it before. So I think a lot of importers will probably look at that and say we should probably think about pre-staging. One of the other things about this is ocean TEUs.
Yeah.
What isn't measured in that data is the freight that's going from China to Mexico.
Right, not in this one. You're right.
And so we're seeing a lot more volume that's not accounted for.
Yeah, we talked about that last month.
Correct. That's going into Mexico, that's not going through this data set, that actually you have even more exaggeration in that number. And I think we'll see a lot of staging. Now, one of the things that's going to be interesting is, does Donald Trump end up putting tariffs on Mexican inbound goods? You know, UMSCSA. UMSCA.
There we go. Another acronym.
Or NAFTA
That's what we all
2.0.
Yeah.
I like NAFTA, it's a lot easier to say. That was a Donald Trump policy. So the question is he going to also look at Mexico imports is he truly going to put a tariff on them? And I don't know. And so that's a big question that I think is going to resonate.
Oh, maybe we didn't.
So the bottom line is, Zach, I do think we will see increased imports in running like we did back in 2017.
Right. Yeah, and that created, there was other mechanisms at work there too.
It was the Trump tax cuts.
Yeah, the tax cuts and things like that. But I think, we actually saw a pretty decent pull forward in 2019.
Right.
Where the threat of additional tariffs became very real in May that year. We saw a huge amount of pull forward, activity increasing around the port.
Yep.
And that's one of the things that, inside of some of our data, we've already seen Southern California outbound demand, and J.B. Hunt even talked about it in their earnings report, that their Southern California intermodal demand was double.
Well, I mean, it should be because a lot of that is import driven. And if imports are strong, while they're not doing international container flows,
right?
That's all domestic containers for J.B. Hunt. There is a tight correlation between import activity and long haul, intermodal activity. So I do think we will see more imports. I would be bullish in that stance.
So demand's going to be strong. We're simply waiting on capacity.
I think demand relative to capacity or demand, actual demand numbers are going to continue to be strong. I don't think there's any risk of that at this point in time. And I think we could see it accelerate throughout the rest of the year, potentially. And I think as that takes place, other parts of the economy are turned on. I think housing is a big risk. Auto is a big risk. Those are the big CapEx items, are the big ones that need financing is a risk. I think those things also play in.
Well, real quick before we get to Q&A, I did actually have the housing chart on here, and we just had a pretty big release, and this was kind of a downside swing. I think down about 14.7% month over month in terms of an annualized housing start. Are you concerned about this at all? It looks like we had a bad month, but in the context of this chart, I'm not so sure that it's meaningful yet.
In terms of freight demand, it certainly impacts things, but there is enough housing. The crazy thing is as high as inflation rates are, there are still people building homes.
Right.
Builders are building. They're reluctant to build, because they don't want to get ahead of themselves. But there's still high demand for housing, even in spite of these interest rates. A lot of these are cash buyers, particularly in parts of the country where the delta between a house in, say, Tennessee versus California, you're seeing a lot of out-of-state buyers that have accumulated a lot of wealth in their homes and equity are relocating to parts of the country that don't have the super expensive homes, and builders are building. And I think that because of that, I think this number is probably steady where it's at. I don't know that it will trend lower. And look, one upside of if you call it an upside, is if things do slow down, if the economy does slow down, the Fed, even though it's not likely to cut quickly, is certainly ready to cut. Like, I think Jay Powell wants to cut.
Sure.
And I think they will look at the data, and if they see significant slowdown in the data, they will think about that. Look, Biden's given a lot of college tuition reduction. We talked about that being a drag. It really wasn't. I think we got that wrong.
Yeah.
Like, it really wasn't a significant impact.
Didn't do a
to the
thing.
consumer economy. And now they're doing a lot of other, a lot of these sort of giveaways and promotions. They're doing a lot of that in an election season to sort of win favor. I think we'll see a lot of that type of stuff come. Where they can do it within limitation,
Right.
even if it ends up getting overturned, I think we'll see a lot of the posturing happen right before the election.
Interesting. Little stimulus. All right. Well, I'll turn it back to MA to get us started with Q&A.
All right. Thanks, guys, as always, for the insights this month. Really appreciate you being here, and lots of great questions we've already seen come through as well. So we'll go ahead and dive in. If you've not had a chance to submit your questions, you can do so through the Q&A box in your console. First question for you guys. How much of the increased freight volume do you think is currently going to private fleets versus for hire fleets?
That's a great question. The tender data doesn't have a ton of private fleet because it's one-to-one. Like, they're not tendering. They
don't tender to each other.
Party. But I do think certainly private fleets have picked up a lot of the capacity. We know that private fleets expanded aggressively during COVID and have continued to do that. And so certainly I think they are a factor.
Yeah, we talked about the Class 8 orders growth. Actually, a lot of that was private fleet investment. So we know that's happened. We're not sure exactly how much, but it's definitely a factor. Yeah,
for sure.
Next question. Why are elections so detrimental to the freight market?
I mean, that depends on perspective.
Yeah.
I don't know that I think elections are impactful, not necessarily detrimental.
Right.
I think you have to sort of look at every election as its own independent impact, because depending on, like, if Biden wins office, I don't think, and if the polls were running up to the election, and it became, if it became clear that Biden was going to win, I don't think we would see any reaction for it. I don't think the economic data would change a lot. Right. The prognosis of it. I mean, both Biden and Trump tend to have relatively progressive policies in terms of trade, or sort of like deglobalization oriented. Biden tends to focus more on sort of social programs. Donald Trump tends to focus more on sort of capital formation and discounts to businesses. And I think both of those sort of play. And I think if you do have an administration change, you have to sort of figure out what the impact of it is. So I don't know that the word detrimental is the right term. I think it's more impactful. And they're impactful because you have the most powerful country on the planet, the world's reserve currency, that drives something like a third of all economic activity globally, the world's largest consumer market. And I think because of that, it matters. I mean, if you go overseas, almost in every country, they're paying attention to their local election, and then they pay attention to ours. And so the United States election season is a global phenomenon, because it's we have so much power and influence over the world that people really care.
Yeah, so I'll go back. We mentioned this a little bit earlier about the 2017, 18, 19 environment where Trump was the president. And to me, that was both positive and negative. Now, if you were looking at, I mean, from a pure demand standpoint, because when you're looking at what happened where we had stimulus to the economy, what that did was it overheated and then it fell off. And so we had what was then a huge bubble economically. We had a big expansion in spending there, capital expenditures, and then it fell off. And so the infrastructure.
You also had the import issue. Yeah. You had a lot of pre-run up in imports.
So it overheated the space, which initially looked very positive, but then over time it kind of fell out and it cooled, and everybody that had adapted to this new world.
It's the same thing happened in COVID. That wasn't presidential driven, but was driven by, when you have high demand, the ability to create new fleets, there's no barriers to entry. The ability to expand your fleet is almost instantaneous. It happens within a couple of months.
Right.
And I think when you have a situation where you have a short-term burst of economic activity
Yep.
and demand, if it goes on for more than just a couple of weeks in many ways, you will see expansion of the fleet and the capacity, and we end up paying the price in years later. So, the only thing that I would say is this is impossible because it will be change in public policy. I mean, one of the things that you can bet on is that if Donald Trump gets into office, that there will be a lot of policy orientation changes. If Biden stays in office, then I think there'll be less policy changes, but probably more programs that are sort of more populist, sort of
Well, the industrial
progressive
spending,
stuff.
the infrastructure spending, et cetera.
Big bills. They both like to spend money. They just do it in different ways.
Right.
And I think because of that, we will see different levels of impact.
Something will happen.
Awesome. And next question. It says, is the Red Sea Suez Canal crisis still pushing more freight to the West Coast ports? And if so, how much? And do you think concerns over heightened geopolitical risks in the Middle East will add to that West Coast cargo push?
I think so. The initial sort of impact, I think, is largely gone. You can see that in spot prices, spot rates.
Well, to North America.
To North America, but the rates, even the rates out of China to Europe have cooled off quite a bit. The premium is discounted at this point, but I think certainly shippers are thinking about moving freight to the West Coast. But it's not just the Middle East.
Panama Canal.
The Panama Canal is a real issue.
Still a big deal.
There's still a lot of excess capacity available on the West Coast to handle a lot of import activity. And a lot of it's pricing. I mean, a lot of it has to do with the fact, where's the cheapest way to import goods? We saw, obviously, a trend during COVID when there was massive West Coast port congestion.
Right.
We saw a lot of freight move to the East Coast. That's reverted in many ways back. I don't think 100%, but in many ways back. I think that's played out. Geopolitical risk is a real problem or real issue.
That's an ongoing thing.
But
yeah,
sure.
Yeah, the West Coast. The Red Sea Suez Canal thing isn't as impactful to North America as it is to the European place. But the thing is, and I was just down, I think I listened to Emily from Zanetta talk about how it's largely been absorbed and it's continuing to be absorbed with available capacity. The biggest differentiation is service. A lot of people are going around the Cape of Good Hope down in Africa, and that's creating some delays to Europe. It's not having a huge impact on North America for any kind of rate situation because there's just so much available capacity. And it looks like more capacity is coming online in that way. To me, the big risk, just as the question kind of insinuates, is that what does that mean later in the year when trucking capacity may be a little bit tighter, especially out west, and where it stretches these freight networks across the country a little bit more? If people have largely gone back to that West Coast, easy, like path of least resistance, easiest service, right now it's a relatively low cost. What happens when that starts to become a little bit less?
That's actually another reason to be bullish.
Yeah.
Is that the import numbers alone, because not all that freight is showing up on trucks immediately.
Right.
A lot of it's going into warehouses. And so as freight comes in and imports continue to flow into from overseas, it ends up in warehouses and it may sit for 6 months. But there will be a big push as we head into peak season, third quarter retail, to move that freight from those warehouses. So the import data is probably less relevant for the day-to-day trucker today. But when we look forward to October, November, I would want to know how imports have been trending before that, because that will tell us a lot about what kind of peak season we would have.
Oh, it's extremely relevant in the way that it's telling you what shippers' demand forecasts look like.
Exactly. and what is it saying right now, Zach?
It's saying that they're pretty bullish. They're pretty optimistic about continued demand.
Yep. If it ends up in their warehouses, they got to move it regardless of that side of it. So I think it's another reason to be fairly bullish.
They're not always right, but they're telling you.
They need to move it.
Yeah.
Excellent. Next question for you. With asset carriers increasing their spot rate exposure to protect contract rates, do you view this as a contract rate floor where instead of contract rates coming down to spots, will spots eventually be pulled up to contract rates?
I think we just completed or in the process of implementing new contract rates. I think the contract index is going to come down. And I think as the contract index comes down, I think we will continue to see a closer, that spread will start to tighten.
Yeah, well, it already is. We're seeing contract rates they are slowing significantly. And I think we're starting to see spot rates, they've already found their floor, according to the data. They're actually rising up and to the right since May of last year. It's a jagged path. It's certainly not an even one, but it's a situation where contract rates have largely felt all of that pressure, and all that juice is largely being squeezed out, especially as Knight Swift is saying, like, there's nothing left there for us. And also they know that they don't want to set themselves up for failure later in the year with an account.
Yeah.
Because if they put a rate out there they know is not good for 12 months, there's a service risk there.
Yeah.
Next question, it says punctual tax filers get their returns back in the spring. Could the blip in capacity have anything to do with the anticipation of the economic consumer market activity? And if not, do you have any other theories?
I think what caused the blip in capacity expansion was seasonality. I think March, like I said, I think a lot of folks took off during the winter. It's always a bad time. And I think drivers came back out, perhaps they left the industry in December, left their motor carrier job, their driving job. It takes 2 months to start a business, and perhaps that's when they got through the process. I think that's an answer on where we saw expansion.
Yeah, we looked into some of the back end data too, and the mix of entrants was not all the way away from the dry van sector, but it had skewed a little bit more in the first quarter towards refrigerated and flatbed and tank expansion. Not saying that was the entirety of the explanation, but certainly those sectors had a little bit more reason to grow. And we've seen that shift because this does count those operators as well as the dry van.
It's also, keep in mind, it's a net number.
Yeah.
So you also did not have a ton of revocations. Because
right.
Frankly, if you're going to leave the industry, you're probably going to leave it in December.
Right.
You're probably not going to carry into.
And revocations have been trending lower.
And I think a lot of that would wear the revocations.
Yeah.
So I think that's also part of the data point. The fact that it hasn't trended up, we didn't see a recovery in green and a build, suggests that this could go on for a while.
Yeah, I mean, that's a huge, big mountain to come down.
They're certainly biased to
growth.
Shrink.
Yeah, it's biased to growth there.
Well, currently it's biased to shrink.
Well, right now it's shrinking.
All right, next one for you guys. It says, which U.S. markets are early bellwethers to watch for changing market cycles?
That's a great question. I'm glad we got that question.
That's a great one.
I look at the ports, like the port cities, as a first indicator. LA is always a sort of go-to. Looking at LA
That's my
as a
favorite.
bellwether.
It used to be Chicago.
Well, Chicago's great,
Yeah.
but it's a second city, right? Like LA is always my indicator. So I go look at how LA's pumping that tells me how the broader U.S. is, because that's the number one port in ocean port market in the world, or in the United States, sorry. And then you get Chicago because of the fact that it's in the middle of the country. Atlanta
Railheads.
is important. Dallas, less so, but still has a little bit of bellwether.
Dallas is becoming increasingly important. I mean, they've become kind of that next. I mean, they've always been kind of that next tier. Look at the railheads, but it all relates to the ports, like you said. I'm looking at Savannah. I'm looking at Atlanta, Dallas,
Newark.
Los Angeles. Newark, yes, to a point, but a lot of that freight stays right there.
Yeah,
So
local.
Yeah.
One more here. It says, when do you see the freight market going into an expansion cycle?
Well, if you're looking at volume, it is there. We're seeing expansion relative to where we were a year ago. I think to cross the threshold of where we were in 21, to truly expand and sort of new heights, I think it's going to be a year out at least before we could sort of say we're in an expansionary cycle.
Yeah, especially when you're talking about new equipment, new authorities, trucking. I mean,
Tender rejections would be, I mean, you could look at an 8% or above tender rejection rate would tell you really that.
and it's got to be sustained. I mean, if you remember that chart that I pulled up about, the contracts and the tender rejection rates, like it took a while for the market to recognize. Like you're not like, oh, we're at an 8% rejection rate, we're going to go buy a truck now.
Yeah.
It takes a long time. Like capacity expansion and deterioration takes a lot longer than demand creation and
100%.
destruction.
All right, everyone, that is all of the time that we have for today. So thank you all so much for taking the time to listen in and for bearing with us through the technical difficulties at the beginning. I hope it was worth your while. Thank you again to Zach and Craig for being here with us today and sharing your insights as well. Be sure to mark your calendars for 2 p.m. Eastern on May 23rd to join us again for next month's State of Freight webinar. And finally, if you have never attended a FreightWaves event before, we have the Future of Supply Chain event happening in Atlanta, June 4th and 5th. We are offering $800 off the cost of your tickets right now. You can visit live.freightwaves.com to purchase those. Thanks again for being here with us.